Before we kick off, there's just two key points I'd like to cover with you about today. Firstly, a little bit about Millennium Capital Managers, and secondly, a little bit about Micheal Von Pfyffer, who we're extremely excited about having with us in the team here at Millennium. For those of you that aren't fully aware of Millennium has a number of very highly skilled and experienced investment teams, and these teams specialise in what we call the core asset coverings, which is money market, fixed interest, Australian and US equity markets. Each portfolio that we run have two fundamental objectives, and they are the preservation of capital and secondly to provide consistent and regular returns. Now a little bit about Marcel himself. Marcel actually heads up our S&P 500 equities portfolio, and as such has a very keen interest in the US markets, their comings and their goings. Marcel joined us just over 12 months ago, having over 17 years experience in strategic and tactical asset allocation and portfolio construction. Marcel's worked in the US, Europe and Australia, and has worked for companies such as Banco Santander, Goldman Sachs, a private foundation in Zurich, and prior to joining Millennium, he was the Director of Strategy at RBS Morgans in Australia. You might have heard of Marcel previously. He actually presents on the ABC radio and has presented to federal senators and MPs on economic briefings. And Marcel is a regular on Sky Business Channel and on the Sky Switzer show. Now quickly back to Deb.
Thanks, Mark. Well, it appears that most of our attendees have already logged on. Maybe a few of them are having a few technical issues like we had just before. So just briefly, once again, if you have only just logged on, if you want to ask Marcel a question at the end of his presentation, you're free to do so by typing a question in the question box, which is in the dashboard on the right-hand side of your screen, or you can raise your hand and physically ask Marcel a question. But for now, over to Marcel for his presentation.
Thank you, Deb, and thank you, Mark. Good afternoon, ladies and gentlemen, and thank you for your time this afternoon listening to what I'm going to be speaking about, the US debt ceiling, which I assure you, despite its seemingly pedestrian title, is actually something that is quite important to all of us. So, the US debt ceiling. Next year, in February, so 1 week before Valentine's Day, for those of you who are non-romantically inclined, that'll be the 7th of February, the US will breach its statutory debt limit. It'll breach it if the Congress can't sit down together and negotiate an increase in the current debt ceiling. If it doesn't do this, if it doesn't raise the debt ceiling before midnight preceding that February the 7th, then we will have an unmitigated disaster of global proportions. But as I progress through this presentation, our position here is that breaching the debt ceiling, which would lead to US sovereign debt defaulting and downgrading of the US credit rating and limits, is really an inconceivable outcome. Okay, so we don't really believe that the global Armageddon from a financial perspective will actually occur on February the 7th. The presentation will take 3 parts. I've outlined here on the slide the current state, the worst state and the future state. That's going to be fairly self-explanatory. What we're looking at here will be where actually is the debt ceiling at the moment. If the US didn't actually raise it, what would occur therefore, and remedies at the administration's option to actually remedy the situation in the future. And of course the conclusion will be what our perspective is on what actually is going to occur. Okay, as we go through the presentation now, first of all, this is a chart put together by the Office of the Management of the Budget, which is staffed by the current administration. And this chart, as you can see here, there is really nothing new under the sun that's occurring. This time is not different. The federal government in the United States has increased their debt limit on a near annual basis, quite frankly, with the exception of the stewardship of Bill Clinton when the US government actually did pass a budget. But consequently, the US, the subsequent administrations have shown remarkable feats of accomplishment in continually pushing up the debt ceiling. Now, the problem here is one of debt serviceability. As we know, they actually have to pay interest on this debt, and that burden of that will fall upon households and companies and the government itself. A gentleman who's probably familiar to most of you, Paul Krugman. He writes extensively, and in his New York Times column a few weeks ago, he wrote an interesting piece in which he said that there wasn't actually anything to fear about the high levels of debt that will inhibit growth, and he cites the experience of the United Kingdom back in the 19th century. And what the English went through back then in the 1800s, they had a very, very high level of debt relative to GDP at the time. And coinciding with that, they had low and stable nominal interest rates. Now that's all fine, well and good, and his message ostensibly is, so therefore, if it's happened before in history, why do we need to worry about it, about debt levels that are this high relative to GDP? Because the English have shown us that they got through it quite fine and ruled most of the continents and most of the seas for a long period of time. But the issue with his statement is his reference to nominal interest rates. Okay, so what we're really concerned about here are real interest rates, which take into account the level of inflation, and this was jumped on fairly quickly by a lady called Carmen Reinhardt, again, which may be familiar to some listeners this afternoon. She co-authored a book with Kenneth Rogoff called This Time is Different, and what Professor Reinhardt picked up from Professor Krugman here is that if low nominal interest rates, and the US obviously at the moment, we are at the zero bound. So cash is ostensibly free in America. It oscillates around 0.14%, the overnight federal funds rate, but credit is essentially free as far as the Federal Reserve is concerned. So Professor Reinhardt's point here is that if low nominal interest rates were, and I quote, the ticket to economic prosperity, then the Great Depression of the 1930s could have been considered a boom. So her real point is that nominal interest rates in the US through the Great Depression were around zero, but they had deflation at the same time. So that deflation actually caused some of the highest real interest rates in American history. So the distinction that Professor Krugman has made is not one that I would place a significant amount of credence upon, because, and I'll reiterate upon this point as we go through the presentation, sometime in the next 2 to 3 years, the Federal Reserve, under the incoming stewardship of Professor Janet Yellen, who will be taking over the reins from Dr. Bernanke early first quarter 2014, Dr. Yellen understands that at some point in time, the next 2 to 3 years, the Federal Reserve is going to have to raise rates. So irrespective of where the level of inflation is at the time, and obviously they will look to that as a barometer, but they are going to have to raise rates at some point in time in the next 2 to 3 years. So this chart that I've got in front of you here, the problem here is that the budget is not particularly under control. Because it's not under control, spending rises. They do not have sufficient funds, or have not garnered sufficient levels of revenue to service the debt that they've got. So as a consequence of that, the bipartisan Congressional Budget Office, which is staffed, as I say, from bipartisan people from neither sides of houses of politics, projects that should the levels of debt continue at their present rate, given the legislation that has been enacted in the last couple of years, the last few years, then we are going back into a situation by 2038 where the level of debt that the US government has outstanding in the market as a proportion of GDP will be commensurate to what it was in the post-World War II periods, which is not particularly healthy. Okay, the chart I've got in front of you, the chart is fairly self-explanatory. All of these lines here are in trillions of dollars. That's T for trillion. And as someone once said, here a billion, there a billion, pretty soon you've got a trillion. We've got the market cap of every constituent company of S&P 500 here, represented by the blue line, in trillions of dollars. The green line is the GDP of America, and the red line is the federal debt level. Now, again, the problem with this graph, and the numbers below there speak for themselves, is that US GDP is probably going to hit, I think the Federal Reserve, their scope, or their forecast range for next year is around 2.1%. They're probably somewhere between 1.9 and 2.3, but let's say 2.1%. Long-term GDP growth rate in America is somewhere between 2 and 3% per annum, but the introduction of Obamacare, the healthcare programs which encompass Medicare and Medicaid, and in addition to this, the Social Security component, all of which are discretionary spend that the government enables itself to make. The problem is that those expenses are going to grow because of the demographic structure of the United States and the labour market in the United States. The burden of the healthcare spend is going to grow at 7 to 9% per annum, whilst GDP, if it does grow at long-term averages, is going to grow at 2 to 3% per annum. Okay, so on this chart, the top right-hand side, the federal debt level and GDP in dollar terms are kind of about match levels. Now, there are other issues going on here. Some of that debt is actually owned by the Federal Reserve, right? So there are a few quid pro quos here, but the issue is that the spend on healthcare is going to, on an annual basis, be larger than, grow larger than what the country is actually making each year, and they have to issue more debt to service that. So this is a budgetary problem. Again, 1997, there was the last proper budget passed. I am aware that there was a passage that went through late of this calendar year, 2013, which I think we can all refer to as a continuing resolution. It wasn't so much a proper budget that was passed. The last time a budget was passed was by Bill Clinton, who was a Democrat and was president, and the Speaker of the lower house was Newt Gingrich, who was a Republican. So that's, harking back to 1997, that's a long time in between drinks. And as I say, if a budget is not passed, then the lower house is unable to enact what is referred to as a continuing resolution. And as I put there, they're functional, although sometimes messy. And again, there's a distinction again here between what is a government shutdown. Government shutdowns really don't actually impede either financial markets or economic growth very much at all. There have been a number of these occur, like double-digit government shutdowns that have occurred since 1973. So the market rolls on, but again the issue here is that the budget is the problem, and the level of discretionary spend that's being embarked upon, there's simply not enough money for it to continue. So let's just take a quick little look here at Economics 101, or perhaps even Accounting 101. Those of you who do run a company, run your own business, you will understand that you have to balance the books, and if you don't, then you need to get an overdraft. Now, you'll be happy to know that your skill set is equally substitutable, therefore, into running a country. Government taxes is company income. Government policy spending, which is discretionary, are company expenses. So the federal debt level, it goes up for two reasons. First of all, government has to sell debt to the general public to finance budget deficits, which in turn are deficits because the government has decided that there are certain policy programs and platforms that is the predilection of their government, and being elected, that's their mandate, and they want to pursue those. So that's fine. And the second point is government will issue debt also to government accounts. So this goes directly to supporting the spend for programs such as Medicare and Social Security. And when both of those happen, debt increases. So in the bad times, in the good times, it's fine. When your economy is growing at a rapid rate of knots, then that's fine. You can afford the debt, you can afford to service the debt because the real economy is actually generating sufficient levels of income to do so, and in turn, in boom times, the government, or the IRS, more to the point, the Internal Revenue Service, is reaping sufficient revenues for the government out of the tax base. What has happened, though, through the Great Recession, as is referred to in America, as the rest of the world refers to it in some parts as the GFC, in the Great Recession, asset prices fell significantly. And as I just spoke about, what that in turn does, it reduces federal revenue. So the amount of CGT and corporate taxation that are able to be harvested by the government just simply aren't there because the economy is in recession. The second point is that the inevitable social consequence of a recession is, of course, job losses, and then subsequently unemployment goes up. It'll surprise quite a few of you, I would suggest. If it doesn't, I apologise. But the next slide, you will actually see that individual income tax, the revenue garnered from individual income tax in America, are actually the largest component of federal revenues. It's massive. Other effects of the GFC, automatic stabilisers kicked in. For the Keynesians out there, you'll be firm proponents of this type of policy. Automatic stabilisers work very well. They come in the forms of unemployment insurance, income support, etc. However, You will also know that they therefore increase federal spending, and again, if the government wasn't actually running a budget surplus when it went into a recession, then if it does enact automatic stabilisers, it has to, by necessity, issue more debt to pay for those automatic stabilisers that'll kick into the economy. So again, the money has to come from somewhere. Okay, this is the slide I just referred to previously. You have a look here, this blue line here, this is the level of individual income tax. These are the government revenues in billions of dollars by major source. So individual income tax and taxes from social insurance are the main components of where the government gets its money from. So this blue exploded pie chart here, this wedge, and the green wedge. This little rusty coloured fellow here is what the government is able to reap from income tax rates belonging to corporations in America. It's this line here. It is dwarfed by the contribution that the individual levels of income tax make. Now, it's a conversation for another presentation, the amount of money that the very large cap constituents of the S&P 500 actually hold offshore and are not taxed. That's a conversation for another presentation, but suffice to say, excuse me, and this would be political suicide, but the easiest thing to do here would be to go to the electorate and actually raise the level of income tax on individuals. Okay, that would be the easiest way because that's where your largest captive base is. And secondly, we'll come to it in a little bit, they also need to introduce a VAT, or in this country it's referred to a GST. Okay, that's where we are at the moment. Now, if things go terribly wrong, okay, if 1 week before Valentine's Day there's not enough love in the Congress and they can't all sit together and agree on things, and then we hit midnight, everything goes wrong and the US government defaults. Where does the debt reside currently? Now, these two charts, they represent the same things. The left-hand exploded pie chart is a percentage breakdown of the $16.8 trillion of debt that's outstanding by the US government. The right-hand pie chart is quite simply the dollar amount. Okay, so the Federal Reserve and government accounts own $6.7 trillion, T for trillion, dollars worth of that $16.8 trillion, which is 40% of the money. Now, the worst case scenario, as I intoned in the introduction, is that if the US government doesn't cover its interest payments on that date, the US government will default. It'll be the first default in history. For those of you who will pick me up on that, yes, I am aware there were 3 other prior technical, shall we say, defaults, but again, they've been referred to by the Treasury as merely technical delays in actually making the interest payments. So it's never actually been taken as writ that the US government has defaulted, and definitely not on this scale ever before. So if they did, then we've got a problem because of a thing called the Basel Accord. Now, the Basel Accord came about, its main job is to tell banks, financial institutions, how much of Tier 1 capital, and I'm just going to keep this very, very simple, how much of, let's say, AAA rated paper that they have to hold is agreed to by all the central bank and all the macro-prudential regulators globally, and its decision and its ruling on this is totally binding to every international institution and bank. So these guys have to own a certain amount of AAA rated paper. The most liquid, the most deepest amounts of volume tradable of AAA rated paper in the world is, of course, US Treasury instruments. So who owns this stuff? The Federal Reserve, of that $6.7 trillion, the Federal Reserve owns nearly $3 trillion of that. Of this wedge over here, foreign and international, that's of course China and Japan. Mutual funds hold 6%, or about $1 trillion. There's about 2% of this debt living in institutions and funds in the Cayman Islands, and OPEC, which is the Organisation of Petroleum Exporting Countries, they also own about 2% of this debt. So The interesting thing to note here is that what the Treasury, the US Treasury, calls other investors is denoted by individuals, government-sponsored enterprises, brokers, dealers, bank personal trusts and estates, corporate and non-corporate businesses and other investors, right? So there is a lot of financial institutions and a lot of funds around the world who have to own a certain amount of AAA rated instruments, and on slide 13 here, the risk that the Basel Accord gives to those instruments, which are US Treasury bills and various other duration US government bonds, is zero. So they think that the chance or the likelihood, the probability of the US government ever defaulting on a payment, an interest payment, is zero. Okay, so again, I don't want to go too far into this, but there is a certain level of these types of instruments that every bank and financial institution is dictated to holding, and mandates for companies that run managed funds sometimes also have to have X amount of AAA rated paper. So these guys all do here on this chart. So the problem is if default does occur, putting aside China's position of the amount of debt that they hold, because quite frankly there is no substitute for the quantum, for the amount of US treasuries that they own in the combination of T-bills and 10-year bonds. Put aside Japan's 7%. They don't really want the money back anyway, so they've got significant holdings. Again, they've got a volume issue, and all the other bodies that I mentioned. There's about $5.8 trillion there. So if they can't come to a semblance of an agreement to increase the debt ceiling on the 7th or before of February next year, then there is an awful lot of AAA rated paper out there that will have significant and material impact upon the Tier 1 capital levels that all of these institutions here hold. Okay, so my main point here is that it is, on this sole point alone, it is inconceivable that the US government will actually default and choose to not raise the debt ceiling, because the predominant majority of people who constitute the Congress and the Senate in the US are comprised of Democrat and Republican business people, and they, cometh the hour, they will make the right decision. Okay, let's have a quick look at where the government actually spends its money. And this is kind of important, because this is walking down a policy path here. On the left-hand side, we've got the level of outlay since 1973 to current times. The graph does extend to 2012, just not the number. Social Security, the blue line there, that's the biggie. The next one's Medicare, the rusty red one, then income security and Medicaid. So that's broken out here. Medicare, Medicaid and Social Security all contribute 9.8% of GDP. When I say contribute, that's contribute towards what is spent. Okay, so 70% of what the government has legislated to be mandatory spend, so Obamacare, to give it its proper name, the Patient Protection and Affordable Care Act, introduced, that is now mandatory spend. Okay, so 70% of mandatory government spend, which encompasses all programs, is comprised of those three entities. That's a lot of money when you are not getting a lot of tax revenue in the door to pay. This is a chart from the Congressional Budget Office. Again, these projections go out to 2038, and many of you should, sorry, I was going to say will and probably should, scoff at any economist projections that go out to 2038. But be that as it may, the expectations here, given, as I said, what has already been legislated to occur and will continue to occur, the projections here are quite dire. And the baseline issue is that there is simply too much money going out and not enough money coming in. And again, the elephant in the room down here is that the federal funds rate is currently at the zero bound. Interest rates in America are not going to stay at zero forever. They are going to rise. It's an inevitability, which means it eventually will happen. And when it does, then the interest component, the debt serviceability issue, is really going to hit home for America, and it will not be pretty, because this other thing called federal spending on healthcare continues to grow quicker than the rate of change is growing quicker than the rate of change of GDP. So the CBO, as I said, is a bipartisan organisation. They've sat down, they've put a paper together suggesting options that they have to lower the debt, so either spend less in certain areas or increase revenue from other areas. For your ease of reading here, I've highlighted them. I've tried to get something with a quantum above about $100 billion or so something that'll make a material impact. And as you can see, a lot of these pertain to Social Security. There's a funny one here. They actually want to change, and this has been going on for a little while, they actually want to change the methodology as to how inflation is constructed, how the measure of inflation is constructed in America, and that'll have actually quite material impacts upon how certain institutions index and scale their bearing to inflation. Fight less wars, which is quite different from building aircraft carriers. So again, fighting international wars is very expensive. Increasing domestic spend on domestic defence is actually good for the US economy and is a lot cheaper. Stop intervening and giving away money overseas. Increase individual tax rate will raise it by about $700 billion, which is a very easy win, and decrease tax deductibility. There's another trillion. Again, as you can see, a lot of these pertain to Social Security or taxation issues, which is really where it's got to come from. This one here I can never see happening, particularly in the light of the European Union's colossal failure in this regard, where the price of carbon per metric tonne, I think, is rocked down to about €2. And I just can't see the oil lobby in America going for that, although it would raise over $1 trillion. Spend less on Medicaid, more tax deductions, and what have you. So, in a nutshell, the best ideas that they've got is to raise taxes on individuals, not companies, which is a point I alluded to earlier. Stop fighting wars. Again, this is different from domestic defence spending. Stop handing out money overseas. Allow the Bureau of Labour Stats and the Bureau of Economic Analysis to change the current methodology for how they measure inflation. And those three last points there I have intentionally, they all mean the same thing: spend less money on healthcare. Okay, this final chart here comes from a website called factcheck.org, which is Democrat friendly, but despite this, sadly the numbers kind of speak for themselves. The problem with the healthcare program, and it's not a problem, it's a very well-intentioned and very moral program, but quite frankly they don't, well, quite mathematically, they actually don't have the money for it to continue in its current state. In the European Union, healthcare, and in this country as well, mind you, healthcare and services that pertain to medical provisioning, they exist at an excellent level of service because the individual income tax levels in Europe are so high. The American capitalist model, and this whole issue is really one of ideology. The way that America is built, not to sound corny, but the way that the American system is built is that the power is in the individual, and they can actually dictate where they spend their money. So if they have a low level of income tax, then the government suggests it's not up to the government to dictate where that money is spent. So there is a reconciling that's occurring between the European model and the American model, and unfortunately the loser in the interim is the US economy. Okay, so what's going to happen over the rainbow? The last slide here. Interest rates are going to rise. So the interest burden on that $16.8 trillion debt is going to rise sharply in 2 to 3 years. This will push the healthcare burden as a percentage of GDP, encompassing federal debt, to its highest level since the Second World War. The Fed will always be there. That's a point really for another time. But as we state initially, I believe our perspective here is that it's inconceivable that a US default will occur on February the 7th, 2014. Markets will react negatively because that's what they do, because of the media spin. And the last time we went through this year, there was never really any chance of the debt ceiling not being raised. So subsequent to that, always comes a relief rally. Okay, so we will be more optimistic on US equities after that does eventuate, hopefully before February, but if not, midnight on between the 6th and 7th of February. That's the end of the presentation. Back to you guys.
Thanks, Marcel. Well, there was certainly a wealth of information there, quite a bit to digest actually, and I'm sure many people attending today will feel the same as I do, that it's probably a presentation that be good to be able to get a hold of in the next couple of days and actually be able to sit down and listen to it again, which coincidentally you will be able to do. Tomorrow you will receive an email from us with a link to be able to download the webinar, and as I said, there was a wealth of information in there, so thanks for that, Marcel. Whilst we give Marcel a tick to be able to catch his breath and have a quick drink before we ask him a couple of questions, we do have 2 quick polls for you. The first one is, have you been or believe your personal investments will be affected by the state of the US economy? So if you can just grab your mouse, click yes, no or maybe. I'll give you a tick to do that. And then once, oh, that's interesting already. We've got everybody so far who has voted has said, here we go, 60% say yes, they think that their personal investments have been affected by the state of the US economy, 20% say no, and 20% say maybe. So our last poll, very, very quickly as well, are you in favour of Obamacare? So mouse is once again yes, no, or you don't really care either way. So far we've got 100% no. See, this is the beauty with live polls, it changes constantly. So 75% aren't in favour of Obamacare. Now it's down to 60%. Marcel, you've had a bit of an effect on our audience now. So currently we have 50% aren't in favour of Obamacare, 33% are, and 17% really don't give a rat's either way. So there we go. Okay, Marcel, we do have a couple of questions here for you. The first one is, who is it that decides the amount of risk-free debt that must be held by certain institutions, and is there any chance they will be called to loosen these restrictions under dire circumstances to allow the holders to keep their government debt? How's that for a mouthful without a breath?
I think you need an oxygen tank to take a breath there, Deb.
Absolutely.
Well done. The answer to the question, who decides it, it's the Bank for International Settlements. These guys sit down in a little place called Basel in Switzerland. Basel, the members of the Basel Accord, as I said in the Prezzo, these are macroprudential regulators. These are central bankers. They will dictate it. So there's a high degree of regulatory consultation that occurs, and they will come up with the answer to this. And as I said in the Prezzo, it's binding, right? So what the regulator says ends up happening. We saw through the GFC what the subsequent follow-through from that were significant capital raisings that took place in European and US markets. We did have a little bit of that in Australia as well, but the shortfalls that were present in the European and the American banks were significant. So they went to the market and they just had to raise more tier 1 capital. The second part of the question, the problem is the ship's kind of already sailed. The Basel Accord exists, and these ratios exist as a buffer in the hope that they actually never ever get breached. They never actually get called upon. So these levels exist as I said, as a buffer, and the likelihood of the probability of these actually loosening, I think the question was, of these being loosened, quite frankly, by the time the guys in Basel would actually sit down to think about that, it would already be too late. So prudence, and this is where the landscape of the markets have changed significantly since the early 2000s, is that prudence now dictates that in the next 20 years, the Basel Accord is kind of aiming for tier 1 levels of possibly up to 19%. In some regard. So that's a huge number, which means, of course, that the bank has less assets to lend out in the marketplace to those with risk appetite. So the domino effect here is there is some outlier for an inhibition of growth further down the track, okay, which is not really what we want, but again, the regulators have to balance that with the other side of the coin, is that are the banks actually operating their balance sheets with a due level of prudence should we actually fall into another or a second GFC. So again, as I say, to the question, as far as loosening is concerned, I don't think so, and even if they did think they could loosen, well, I mean, that is sort of, yeah, the ship would have already kind of sailed, and not to be glib, but if they did loosen it, then I'm sure that would be the prelude to the next GFC.
Thanks for that, Marcel. We've actually got an interesting question here from Martin as well, and I do thank you for that, Martin. He asks, do we need to be more concerned with the Japanese government debt in the near term as opposed to the US debt?
Martin, the person or the people who own a lot of Japanese debt is referred to affectionately in financial markets as Mr. and Mrs. Watanabe. The level of outstanding Japanese debt is overwhelmingly held domestically. Okay, so this is in dire contrast to the level of US debt that's on issue as we go back to some of those exploded pie charts in the Prezzo, you know, a lot of which is held by institutions and people other than those who reside inside the United States, with the exception, again, of the Federal Reserve. But I just have to say quickly that the amount of money that the Federal Reserve has on its balance sheet that it's bought since the GFC has more than doubled. Okay, so the Japanese problem is a curious one. Their problems really started in 1989, and they've been on a deflationary spiral ever since. But the appetite for Japanese government bonds continues unabated. Their debt to GDP ratio is about 220%. Okay, so all the economic commentators that you would see on the TV and what have you, talking about how horrible it was, you know, that Germany's nudging 85% debt to equity. Debt at percentage of equity outstanding. The Americans, if they continue upon their path, they're going to go above 100. The Greeks, as we know, were sort of at 140, 160%. You know, the Japanese leave these guys for dead, right? 220%. But the issue with Japanese sovereign debt is that their risk appetite in that country is so low that the point is that the Japanese bond purchaser, the people who buy Japanese sovereign debt, they don't really ever actually expect to have that money paid back, right? They just want their trickle of interest payment on that capital that they've bought, and they want it for as long as the duration of the bond is. There is a race to the bottom occurring here globally, absolutely. The problem that the Japanese have, if the domestic demand for Japanese government bonds diminish, is that whilst their economy is now showing tentative signs of recovery thanks to the three-arrow policy of Prime Minister Abe, the real growth prospects for Japan are nowhere near as good as they are for America. So America, you know, and this is the benefit of what is referred to as exorbitant privilege that the US dollar enjoys, is that because of the depth and the volume of global markets, and again, this paper is the best quality, best quality is the best quality paper available on the marketplace. Is that institutions simply couldn't purchase as many Japanese bonds to fill up their coffers as they could US bonds. So, yeah. You know, the day of reckoning, of course, will come eventually, but in the interim, until that day eventuates, Mr. and Mrs. Watanabe and Japanese institutions seem very happy to continue to buy Japanese government debt, as their 220% debt to GDP ratio attests to.
Thanks for that, Marcel. We actually do have another 4 questions that we've currently got, so unfortunately if you haven't asked a question, I'm going to have to see if you can email them to us later in order for us to get through this today. The next question is, in the unlikely event that the US does default, how can Australian investors protect themselves?
Protection here, the short-term protectionism clearly would be to move everything to cash, but the problem with that is that by the time that eventuates, it's probably already too late. Look, if the US does eventuate, I can sort of say, with the exception of probably gold and silver, that there would be nearly nowhere safe to hide, unless you have access to either to cash, which is not held, or the bank that holds your cash does not hold any US Treasury bills as part of its Tier 1 capital ratio levels. But the only way to actually profit out of that type of situation, or to be safe, would actually to be invested in a hedge fund that has the capacity to go short. But again, this is really absolute financial Armageddon type status. As I say, the repercussive effects of a US default would be most definitely felt in Australia. It would literally be a second global financial crisis in the blink of an eye. So again, real assets in those sort of points in time, with the exception of cash, obviously gold and silver, would be the safest place to hide.
Okay, so that leads us on to the next question. It's given that the Federal Reserve holds a lot of the US government debt, is this going to be a potential problem, particularly if the US government defaulted?
Doesn't really matter at all to the Federal Reserve. The Federal Reserve can really do what it wants. The great problem will be when the Fed actually has to sterilise or monetise the debt on its own balance sheet. So this $85 billion a month of the bond repurchase program, quantitative easing 3, or QE infinity as it's referred to, that's happening, that's I think in answer to the first question that I think it was Martin who asked, the level of debt that the Fed has assumed since the kick-off of the GFC has expanded the Federal Reserve's balance sheet gargantuously. So if it all does go wrong, yeah, the point is eventually the Fed is actually going to have to move all these short-dated and long-dated bonds that they've bought in the open market. They're going to have to monetize them and get them off their own books. So, yeah, the question is an interesting one. Again, I refer to the notion of exorbitant privilege. Is that this actually ends up becoming an issue not for the American people or the American government at all. This question, the outline is actually, it becomes a problem for people who have bought US issued debt in US dollars, and they either live in countries or they are running funds that are not denominated in US dollars. Okay, so what the question here is asking, this actually, it really won't affect the Federal Reserve. It won't affect the American people. I mean, there are counties in America at the moment who are bankrupt, who are technically bankrupt. They have gone to the wall, and yet they are still managing to get debt issues away. Something happened last week. They got away with $1.6 billion in the debt issue, and that county, that municipality, is actually officially bankrupt, right? So the Federal Reserve and the federal authorities, they can buy whatever they want whenever they want. As I say, this actually becomes a problem of the bondholder who is living in Japan or in China, and if that does occur, they're the ones who actually end up being very upset, not any institution or issuer in America.
Okie dokie. Now, what we're going to do is move off on a slightly different tangent now. This is primarily on a fundamental moralistic issue. The question is, given that the majority of the developed nations in the world already do have public health care available, what exactly is it that the US has to change, given that they already have such a massive spend on Medicare and Medicaid, and your projection is that it's 70% or that I think you said that that's what they've actually said is going to have to be spent in the future on Medicare, Medicaid and Social Security. So, as I said, given that they already spend such a tremendous amount, is there something that they can change in that formula to allow for public health?
They already do spend, so 70% of the mandatory government spend that does occur out of the budget is already being spent on Medicare, Medicaid and Social Security. The issue is completely and absolutely one of ideology. The short form answer for this question is they need to raise taxes, right? So it doesn't really matter if they do want to enjoy, if the population who votes, if they want to enjoy the same level of health care that is available to all the other OECD countries, then those people have to log on to the OECD website and see what the average rate of individual income tax is paid in all of those OECD countries. Right? That's the bottom line. The problem here, and as I said, it's not a problem per se. It is an issue of different ideology. When the United States was founded, the whole part about America, the whole Americanism, the nationalistic fervour is that it's everything's up to the individual. It's not to the government to dictate to the individual anything, or as little as possible. And what that has permeated for the past couple of centuries through America is that you got, relatively speaking, relative to, let's say, Sweden or Denmark, you've got where there are world leader, world best free healthcare providing systems, and Australia for that matter, is that you have very, very high levels of personal income tax, and in Sweden in particular, over 50%. Right? Denmark, again, huge levels of personal income tax. So that's where, and one of those charts that I showed here, that that is where the majority of where the US government can actually get its revenue from, back on slide 10. Okay, so that at the moment that's where it's coming from. So if the population, and it's totally up to them, but the next administration is going to have to tackle this issue head on, because those projections, they're done on an actuarial basis, so they're not fluffy crystal ball type economist type projections. These are actuarial projections. So if America decides that they want to enjoy the same type of free healthcare or what have you, the same level or standard of healthcare cover that their fellow OECD nations do enjoy, then I'm afraid that they do have to understand that that money doesn't come out of thin air, and those countries, the population of those countries, do pay a much higher level of personal income tax than you currently do enjoy being an American citizen. So yeah, it is an ideological issue, and clearly, you've never seen this type of fracturing occur in the US populace probably since the Civil War. The nation is divided over this issue, and it's an issue of ideology. It's an issue of, do I know where to put my own money? If I want to, I'll buy private healthcare cover, thank you very much. Or, we've got the best country in the world, this is the American speaking, we've got the best country in the world, we deserve free healthcare cover, where is it, give it to us. Okay, so those two have to be reconciled, and unfortunately, the problem standing in between the two of them is pure simple mathematics, is that what they want, they're going to have to pay for via increased taxes.
Yeah, that's great, Marcel. Thanks. It doesn't look like it's something that's going to be reconciled in the near future, unfortunately. Our last question for the day is, how could your S&P 500 fund take advantage of the current situation, such as the US debt ceiling?
The last slide that I put up is that when in the past, when we've had a debt ceiling issue arise, and there have been a lot of political posturing over the issue, the markets do react negatively to this. However, subsequent to this, there always eventuates a relief rally, and stocks go up, because people are less nervous and things have been okay. We might have only kicked the can down the road, but things will have improved. However, if you're not in the market before that relief rally eventuates, then you don't enjoy it. So at the moment, as I say, our perspective here is that it's inconceivable that that the US will actually default on that payment. Worst case scenario, we will have the ability to protect downside in the S&P 500 fund. Okay, so we actually do have strategies available to us where we will actually preserve the capital base, and if things go very, very bad, then we will probably actually add to the capital base. The main point here is that over time, obviously the long term, American markets are incredibly resilient and always go up. You can do rolling 10-year returns of average returns of the S&P 500, and the median is about 12%. Okay, and that stood the test of time fairly well, testing on a rolling 10-year basis since about 1960. So the kind of thing is you've got to be in the market to make the money. So the worst possible thing that people could actually do, we believe, at this point in time, going into another potential debt ceiling fiasco debate, is actually pull themselves out of the market, because as past experiences have shown, and I hope this presentation has also explained, that it is just about inconceivable that the US government will actually default on its debt. And when it doesn't, being very positive here, when it doesn't, in February, the market, in light of the fact that interest rates in America are still zero, right? So it's very hard to actually get any yield on money. So you've actually got to put your money into risk assets such as the equities market and the S&P 500. When the market does take a step back and a breather, it sees that the debt ceiling has been raised again, the risk appetite will return to the market, and we would expect further kick up in the level of the S&P 500.
Look, thanks very much for that, Marcel. You've actually given us so much information today. I know myself, I'm looking forward to some of your future webinars for us, and I'm sure many of the people attending today are looking forward to future webinars as well. And I would like to thank everybody for attending, and also for asking some pretty valuable questions, because whilst the presentations are full of information, it's always good to be able to get some feedback from our attendees, so thank you very much for that. Everybody attending today will receive an email tomorrow which will give you a link to enable you to download this webinar, and as I said earlier, I'm sure that it is going to be one that you're going to want to listen to at least once or twice to be able to get everything out of it that Marcel gave to us today. So thank you very much for attending, and we look forward to seeing you at our next webinar. Thank you.